The layoff announcements just keep coming. Disney, Amazon, Twitter, Meta, Microsoft, Salesforce, Citigroup, Barclays, and lots of others. But many of the recent layoffs grabbing headlines are coming from companies with large revenues and lots of cash on their balance sheets. A much larger wave of job cuts may be on the horizon. Debt and a looming cash crunch could be responsible. I'll explain. There are more than 900 companies in the US that haven't produced enough profit to service their debt for 3 straight years, according to FactSet data. That list includes some big names like Boeing, Uber, and Workday. Some economists call these companies zombies, and many of them have a lot of debt. But they've been buoyed in recent years by low interest rates and a historically elevated stock market. Now that debt has become more expensive and the stock market has deflated, there's a real danger that these companies will need to cut their workforces. And the numbers could be meaningful. These companies have a total market cap of more than $1.3 trillion and employ around 1.5 million people, according to FactSet. How did America's zombie problem get so big? Well, coming into 2020, lots of companies were able to stay in business because they could just keep borrowing money as long as their valuation stayed high and interest rates stayed low. For the 10 years from 2012 to 2021, the S&P 500 saw an average total return of 17%, almost 3 times its historic average. That boosted the valuations of public and private companies to historic highs. And bond yields during that period were some of the lowest ever recorded. But in 2022, things have changed drastically. The S&P is headed for its worst year since 2008, and that's making companies rethink issuing stock or going public. The number of initial public offerings in October fell by 95% from a year before. And with US government bond yields seeing their largest rise in history, corporate bond yields have also skyrocketed, making it way more expensive for companies to borrow money. We're seeing mergers and acquisitions and venture capital funding dry up as well. M&A activity in the US in the last 2 months was down by about 43% from the same period last year, and venture capital funding for startups was down by about half in Q3. The Federal Reserve's policies had kept interest rates low and pumped money into the economy, helping prop up the zombies. But the Fed is now signaling its plans to keep raising US interest rates, so corporate borrowing costs are unlikely to return to their historic lows anytime soon. Many of these companies now have to figure out how to operate when they can't just go out and get more money from the market. They're in a cash crunch. We could see some pretty significant layoffs from these companies as they start running short on cash. And some may turn to bankruptcy or liquidation. That's definitely something to watch, even if the economy starts to improve. It's important to have an entrepreneurial mindset these days, as rapper Lil Baby reminds us. He says, "Sun up to sundown, ain't nothing to do but get money. So forget it, I'm working the block. AP cost a cool $250,000. I'm sorry, this watch did not come from me punching the clock." That's all for now. See you next time.